Hello and welcome to my morning note. We had another surprise from central bankers last week. You might recall that 3 weeks ago, Ben Bernanke managed to persuade people that he was going to be tightening monetary policy rather earlier than expected, and that pushed bond yields up. Last week, we heard from the European Central Bank and the Bank of England, and both of them managed to convince people that they're not actually going to be following the Fed quite as quickly as all that. That's caused more gyrations in world markets. Now, what effect are all these words from central bankers ultimately going to have on asset allocation and markets across the world? With me now to discuss this is JP Morgan's global market strategist, Dan Morris. Hi.
Hello.
Let's start by taking a look at a chart that you provided showing how expectations for interest rates have shifted from April before the rash of central bank speak to today.
Sure.
What's going on here?
Well, I think what the central bankers, especially in Europe, were trying to do was to essentially talk some of these numbers down, that the markets, if you look at what the forecasts were predicting increases in interest rates further than at least the central bankers intended to, and they wanted to try to convince them, so he ended up getting this guidance into the future. But I think the bigger question is, will market participants really believe it? And secondarily, does it really matter?
Okay, and if we look at this, I mean, it doesn't look as though the Bank of England and the ECB were that successful anyway. The expectations are still very much higher than they were a couple of months ago.
Yeah, they dropped a little bit the day following, but again, when you had the good non-FAR payrolls numbers out of the US, they went right back up. So I think people appreciate that guidance is fine, but in the end, they're certainly not going to be constrained by it if they see better growth numbers or, heaven forfend, actual increases in inflation, that they're certainly going to raise rates regardless of what they might have guided to before.
So if we take a look at the next chart, so you can see that there are some limits to the monetary policy anyway. While the Fed funds has been stuck at this remarkably low level, we've seen really quite dramatic variations in treasuries and corporate bond yields. I mean, how much control can even the Fed exert over this?
Well, this is certainly a difference between today and what we had in 1994 when you had the big increase in interest rates because the Fed funds rate went up by 300 basis points.
Right.
Now, of course, it's pretty fixed, but consequently, you've probably seen more variation in the market rates. And, really this is what's going to matter to consumers, to households, to companies. The rate that they're going to pay is what the market is pricing credit at and not necessarily what the Fed funds target rate is. So again, certainly has an impact, but I think it's not going to be the most important one in terms of economic growth.
Now let's trace this through to asset classes. We obviously had a very galvanic effect on currencies in the wake of the different central bank announcements. Very much stronger dollar, very much weaker sterling, somewhat weaker euro. Beyond that, where do you see the big shifts that are likely to happen if the central banks continue to convince us that the Fed is indeed going to be more hawkish than people thought a few months ago?
Well, I think it's going to depend, of course, on what asset. For those assets where people were looking for income, be that high yield debt, emerging market debt, equity income, you're going to see less pressure on those asset classes because now you're actually going to start to get some yield out of your investment grade debt. So that's actually going to be helpful. So even though we'll have some short-term pain as the interest rates adjust, it should relieve some of the pressure on them. So ultimately, I think that'll be beneficial. We'll also generate some income for savers because they'll now hopefully start getting some income off of those investments. So I think that's going to be one. Secondarily, of course, rates nonetheless, even with this increase, are quite low. And so equities on a relative basis probably are still one of the preferred asset classes. There's really no reason that they can't continue to appreciate even with the higher rates. So it's not anywhere at a level where it's ultimately going to be burdensome, we think, for equity investments.
Now let's look specifically at emerging market equities, which have obviously had a very dramatic sell-off, which might leave you to think that they're cheap. And according to this chart that you've produced, the MSCI index itself does look cheap compared to its own history. But is there really value to be had out there in emerging markets yet?
Well, I think there is, but I think what people have to understand is that, as always, you have to go beneath the surface, beneath the index level to really see where that might be.
You can't just buy the ETF, in other words.
Well, of course you can, but we think you're probably going to be missing a trick if you do, because even with the index does, as you point out, look cheap relative to its history, similarly on a price-to-book basis. It's really the fact that the largest markets in the MSCI index, like South Korea, like Taiwan, like China, they're particularly cheap. They're very large weights in the index, so that pulls the overall valuation down. But most markets, the median market, is actually trading above average. So there is the opportunity to find the more discounted stocks, but it's going to be really looking at the countries, looking at the sectors, as opposed to thinking if I just buy the index, I'm going to take advantage of that, because when you do, you're actually getting some expensive markets.
Okay, Dan, thank you very much
Thank
indeed. I'm afraid to say the conclusion to all this, yes, the central banks are changing the environment very much, but if you're really looking for bargains, unfortunately it turns out that the cheapest investments are the ones which you'll need the greatest encouragement to try buying, and the most attractive ones are the ones that aren't all that cheap. Never mind, there are still plenty of opportunities out there.